Good evening and welcome to iBanker News tonight on this Tuesday, February 3rd, 2026. Thank you so much to all the positive outsupporting and support, all the comments, and all the smart story ideas, many of which we'll be following up. There are just too many of them. I do this after my day job, as many of you know. I'm an M&A banker, a tech banker, and this is something that I'm doing because really I feel if not me, then who? So tonight we're going to cover the kinds of stories that CNBC, Fox Business, and Bloomberg won't touch. Quick reminder before we start, if you want the kind of financial coverage that isn't sponsored by the very system it's supposed to interrogate, like the video, comment, and subscribe. On this channel, we cover the news that CNBC, Bloomberg, and Fox Business can't or won't touch, because the moment they do, the revenue model starts sweating. So now, let's talk about who actually does pay them. Here's the part nobody says out loud. CNBC, Bloomberg, and Fox Business do not exist to inform you. They exist to monetize your attention on behalf of their funders. You are not the customer. You are the inventory. Let's start with CNBC. CNBC is owned by Comcast, a multi-$100 billion media and telecom conglomerate whose business model depends on advertising, distribution fees, and this part matters, access. CNBC's biggest advertisers? Asset managers, big banks, brokerages, ETF sponsors, private equity shops, crypto exchanges, when that was fashionable. You know, the same institutions whose products they're analyzing. That's not journalism. That's a two-sided market. On one side, financial firms buying credibility. On the other, viewers, you, me, lending trust. And CNBC is the clearinghouse, taking a spread on both sides. Now, Bloomberg isn't really a media company. It's a data terminal company and a news division attached. The Bloomberg terminal costs, depending on the deal, something like $20,000 to $25,000 per year, per seat. The real customers aren't viewers. They're us. They're the banks. They're the hedge funds. They're sovereign wealth funds and governments. The news exists to support the brand. The brand exists to sell terminals. The terminals exist to keep the financial class informed before you. That vertical integration, not independence. You don't watch Bloomberg News to get the edge. You watch it to hear a sanitized, delayed version of what terminal clients already knew. And then there's Fox Business. Fox Business is owned by Fox Corporation, which makes its money the old-fashioned way. Ads, distribution, and audience loyalty. Its incentives are not data-driven. They are narrative-driven. Fox Business doesn't sell you trades. It sells you confidence. Confidence in markets, in institutions. Confidence that whatever is happening right now is normal, patriotic, and probably bullish. Different flavor, same outcome. Now, here's the common thread. All three networks rely on financial advertisers whose revenues depend on market participation. They don't get paid when you de-risk. They don't get paid when you go to cash. They don't get paid when you decide to sit out a cycle. They do get paid when you trade more, allocate more, lever more, believe more. Volatility is bad unless it boosts volume. Crashes are scary unless they bring eyeballs. Systemic risk is contained until it isn't. So what never gets covered? Balance sheet fragility, counterparty risk, liquidity mismatches, settlement risk, off-exchange derivatives, rehypothecation, duration bombs hiding in safe portfolios. You'll hear about CPI prints, you'll hear about rate cuts, you'll hear about earnings beats. You will not hear about who's trapped if liquidity disappears, because that conversation has clients. That is where the jargon matters. Modern financial media is built around flow, not stock. Flows are exciting. Stocks are dangerous. Flows mean inflows, outflows, volume, momentum. Stocks mean leverage, debt, collateral, insolvency. Guess which one scares advertisers? Exactly. And here's the punchline. The ultimate product isn't the show. It isn't the anchor. It isn't even the narrative. It's you, your attention, your trust, your participation. You are the liquidity. So when every network tells you the system is resilient, remember, resilience is great for ratings. When they say volatility is healthy, remember, volatility pays the bills. When they say there's no systemic risk, remember, systemic risk is bad for sponsorship decks. None of this requires a conspiracy. It just requires incentives. And incentives don't lie, even when people do. That's why this channel exists, because the most important stories in finance are the ones that make advertisers uncomfortable, the ones that don't sell products, the ones that make you pause instead of click buy. If you want analysis that treats you like a participant, not a product, subscribe. Because once you see the business model, you can't unsee the coverage. Thank you for watching all the way to the end. We really appreciate all of your participation. Please, if you enjoyed this channel, consider subscribing, like, comment below more story ideas or some instances where you think Fox Business, CNBC, Bloomberg, or other financial news is just not really showing you the whole picture. In the meantime, take care of yourselves and each other.